Ladies and gentlemen, good day and welcome to Steelcast Limited Q2 H1 FY26 earnings conference call. As a reminder, all participants' line will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pranav Khanna from EY team. Thank you and over to you, sir.
Thank you, Ishan. Good evening, everyone. We welcome you all to Steelcast Limited earnings call to discuss the Q2 and H1 FY26 financial results. Today from the management side, we have Mr. Chetan Damboli, Chairman and Managing Director, Mr. Ruchit Pangoli, Whole-time Director, Mr. Subhash Sharma, Executive Director and CFO, and Mr. Vikas, Company Secretary. Please note that a copy of the disclosure is available in the investor section of the website as well as on the stock exchange. Further, a detailed safe harbor statement is given in the investor presentation of the company. Please note that anything said on this call which reflects the outlook for the future or which could be construed as a forward-looking statement must be reviewed in conjunction with the risks that the company faces. With that said, now I will hand over the call to Mr. Chetan Damboli for his opening remarks. Over to you, sir. Thank
you. Thank you, Pranav bhai. Good evening and a warm welcome to everyone for the earnings call of Steelcast Limited for the second quarter and half year ended 30th September 25. We concluded our board meeting today and uploaded the financial results and the investor presentation on the stock exchanges as well as on our company website. I believe you must have got a chance to go through the same. I will start off by giving a highlight of financial performance for the current quarter versus corresponding quarter Q2 of FY25. During Q2 FY26, the revenue from operations was 106.7 crore, a 42% growth from rupees 75.4 crore in Q2 FY25. EBITDA during the quarter was at rupees 34.2 crore, a 62% growth from rupees 21.1 crore in Q2 FY25. EBITDA margin was at 32% and an increase of 408 basis points from 28% in Q2 FY25. PBT during the quarter was at rupees 30.9 crore, a 73% growth from rupees 17.9 crore in Q2 FY25. This translated to a PBT margin of 29% and an increase of 527 basis points from 23.7 in Q2 FY25. PAT during the quarter was at rupees 23.2 crore, a 75% growth from rupees 13.3 crore in Q2 FY25. PAT margin came in at 21.8%, an increase of 413 basis points from 17.6 in Q2 FY25. While the first half of FY26 has been healthy, we expect a slight moderation of softer Q3 due to softer demand and near-term visibility due to geopolitical uncertainties, mainly driven by disruption in export markets, especially the US markets. Our teams are actively executing existing orders and maintaining strong engagement with key customers. However, given the global situation, there remain some uncertainties. Should geopolitical conditions stabilize and trade deal with the US get concluded in coming weeks, we expect Q4 FY26 to perform better than Q3 FY26. Taking all these factors into account, we currently estimate that FY26 will still deliver double-digit growth over FY25. On the subject of US tariffs, I would like to highlight that our products continue to remain competitive position compared to other competitors and also Chinese suppliers. Despite recent tariff-related challenges impacting global trade flows, Steelcast maintains a solid cost advantage. For three of our key product categories supplied to the US, our prices are lower by approximately 5%, 12% and 13% respectively compared to other Chinese suppliers. This cost edge not only supports our export competitiveness but also positions us well to capture incremental opportunities as customers diversify their sourcing requirements amid this ongoing geopolitical shifts. We have been informed by all our customers that they will not change supply chain, and they expect the trade deal to be concluded in coming few weeks. At the same time, we continue to focus on de-risking through geographic and sectoral diversification, expanding our footprint across newer regions and customer segments. Last quarter, we shared that over 3 dozen new components were under development in GET and construction industry segment. We are pleased to inform you that execution of these initial orders in both segments began in Q2 FY26, and we remain optimistic about the growth potential going forward. Just for everyone's information, we have grown at 24% CAGR up till now in last 4 years. We are confident that we will grow 20% CAGR in the coming 3 years. One has to see us over longer perspective with a 2-3 year horizon. Our core segments, mining and earth moving, recorded strong double-digit year-on-year growth in Q2 FY26. In addition, our 2.4 megawatt hybrid power plant, our project to meet our increased volume requirements in FY27 is expected to be commissioned by 30th June 26. This will further enhance cost efficiency and sustainability, generating estimated annual saving of rupees 3.5 to 4 crores. We also expect margins to remain stable at current levels, reflecting our disciplined cost management and operational efficiency. Overall, your company is well positioned to capitalize on emerging opportunities and meet growing market demand over longer term. During Q2 FY26, domestic sales contributed 36%, while exports accounted for 64%. Apart from the US, where we are seeing some moderation due to tariffs and other geopolitical factors, interest from both our customers and investors remains strong, and we are encouraged by continued confidence in our strategy and execution. With that, I would now like to open the floor for questions. Thank you very much.
Thank you very much. We will now begin the question answer session. Anyone who wishes to ask question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Harshil Solanki from Equity Capital. Please go ahead.
Hello, Kiran bhai and team. Good afternoon. Good evening.
Yeah, good afternoon.
So, I have 2 questions. I'll list them all together. So, our domestic sales have degrown by 33% and 5% QOQ and YOY basis. So, if you can highlight what is the challenge in the domestic market, that would be very useful. Next is on the defense part. If you can share any update on the defense export component that was expected to scale up in September. So, what is the status on that? And similarly, if you see in the Indian market, there is a lot of demand for artillery shells. And we have also developed some components like aerial bombs, motor bombs. So, are we looking to participate in that opportunity? And the third question is on the financial side. So, our other financial asset line item in the balance sheet has increased from 22.64 crores to 43.67 crores from March to September. So, if you can highlight what is the jump and what all is included in that 43.67 crores. This would be useful. Yeah, these are my questions.
Yeah, thank you, Harshil bhai. In terms of the contribution of exports to domestic sales, if you see historically, these proportions keep on changing. the lower number will be domestic 35% and export 65%. Or sometimes we may have on a 50-50 basis. Sometimes it's 45-55%. So this keeps happening, and these are cyclical in nature. But there is no strong reason to explain why domestic has gone lower with respect to exports. So if you see historically, this is the range we keep working on. Regarding defense sales, to be honest, we have lost interest in defense segment. We are not putting in any more efforts. We have done enough efforts over last 3-4 year period. And so what we have decided is whatever comes to us without any efforts, we will do. Otherwise, we will not go out of our way, because we've been waiting for last couple of years on whatever products we have developed. Either the tenders are delayed, or somebody becomes L1 and the tender goes to them. So, moreover, we believe defense is a highly risky segment. So, with all this in mind, we are not going to pursue. We'll do whatever comes off our way. Now, regarding this artillery shells and all, some part of artillery shells are forging components. We make only steel castings. Regarding bomb shells and all, in between some tenders came and they went away to somebody who quoted L1. And regarding combat vehicle parts also, something similar happened. So, with all these factors in mind, we are going to do defense only whatever comes without any effort from our side. And we also see tremendous amount of opportunities elsewhere in the world where bureaucracy is near zero, opportunities are tremendous, and there is no one segment we need to focus. Defense becomes a highly riskier segment. So this is our strategy going forward. Now, regarding your question on other financial assets. Yeah, so these are free reserves parked in fixed deposits. So they have gone up from 22.64 crores to 42.67 crores.
Got it. Yeah, thank you for answering. And just one follow-up. You mentioned about the challenges in India defense, but if you can highlight on the defense export component which you won recently, and that was expected to scale up in September and onwards. So, what's the status on that?
So for those defense exports, the first prototypes we supplied in June, which were approved. Then in the month of September, we shipped additional quantities, which have been exported. It will be received at customers' end sometime in mid-November, and then do another testing for at least 10 to 12 weeks thereafter, and then we expect some reasonable business from there. But as of now, this is the status.
Okay. So next year can we expect?
To be exact, we shipped the first 250 numbers in June, which were approved, and then we have shipped 2,000 numbers in September, which will reach the customer end outside India in mid-November, and hopefully we should get some additional business from this segment.
Okay. Got it.
Thanks.
It was very helpful.
Thank you.
Thank you for answering.
A reminder to all participants that you may press star and 1 to ask a question. The next question is from the line of Hemant, an individual investor. Please go ahead.
So, thank you for taking down my question. Sir, I have a query. So, in our last Concall, we had guided for 18 to 20% kind of revenue growth in FY26. But I had a look at PPT which was uploaded. The presentation which was uploaded recently. There we are guiding for early double-digit growth in FY26. So, we are some sort of lowering the guidance. Is it?
Hemant bhai, do you have any other question?
Yeah, I have two more questions. First is,
You may please give out all your questions. I'll answer them together.
yeah, and the second thing which I wanted to ask you is, in our, opening remarks, we have just guided for 20% CAGR over the next 3 years. So are we kind of, little conservative in the guidance? And the third one which I have from my lot is, earlier, we were guiding a capacity utilization of 59% in FY26, then we trimmed it to 53%. So what sort of capacity utilization we are expecting in FY26 now, post Q2? And what was the, will Q3, will H2 be better with respect to H1?
Yeah. Thank you, Hemant bhai. Yes, we were targeting 18-20% growth in FY26, but because of the tariff issues with the US and the Indian government, we started off in April 26. So that there are disruptions, though our customers tell us that they will not change the supply chain, but in the near term, there is a slowdown, and that's the reason we have trimmed our guidance from 18-20% to about double-digit growth, and hopefully we should grow by about 12% this year. Your second question on 20% CAGR, I think you can consider this as conservative and realistic estimate that we have grown over the last 4 years with 24% CAGR, and the coming 3 years we aim to grow at 20%. Because of the disruption, because of the US tariffs, we have trimmed our guidance from utilization of 53% in FY26 to now about 48-49% in the current year, post Q2 results, and hopefully we should be back to normal from Q4 of this year onwards.
So, due to sir, in a nutshell, I can just sum it up that maybe due to tariff-related uncertainties, we are, lagging by 1 year, right?
Yeah, you can say that as 1 year, or the growth which we were forecasting is being trimmed down from 18-20% to 12%. And this kind of massive disruption in tariffs, it's not only companies will not only suffer with the US market, but elsewhere in the world also. The geopolitical situations have also been disturbed. But if you see on a very macro point of view, that our customers are not changing the supply chain, and we have to see always, with a 2-3 year horizon. And we expect to do a 20% CAGR in the coming 2-3 years.
So, sir, can you tell me one thing, sir? What is the contribution from US in export?
Total sales of US share will be about 30% of our total sales.
30% of total sales or 30% of exports?
30% of total sales.
30% of total sales. How much it will be in percentage terms with respect to exports?
Export is 60. Now we have already given the numbers, Hemant bhai, you need to figure this out. We have our quarterly sales is with you. Our export component is with you, so you should figure out this.
Okay.
I would request everybody that this has to be seen in context of the uncertainties prevailing, the geopolitical situations, and disturbance throughout the world.
And so, sir, the capacity, enhancement which we were thinking about, which we were supposed to think about post FY26, it may be postponed to 1 year, right?
We may consider this once again somewhere around end of FY26. We'll review it. We are reviewing this on a constant basis, and at an appropriate time, we will trigger this.
Okay, sir. Okay. Thanks a lot, sir. Wish you all the best.
Thank you. Thank you.
A reminder to all the participants that you may press star and 1 to ask a question. The next follow-up question is from the line of Harshil Solanki from Equity Capital. Please go ahead.
Hello.
Harshil sir, could you please repeat your question?
Yeah, I'll repeat. So, I wanted one clarification. You told that your prices are 5 to 13% cheaper than the Chinese counterpart, and your customers were also not looking to change suppliers. So, are you trying to say that because of the tariff, the end demand from the end users has slowed down, and hence we are lowering our guidance? I just want to understand what is the challenge, because we are still competitive in terms of pricing. And so what is the issue there?
If you see, we are competitive compared to our other competitors around the world and also competitors from China. But with these additional tariffs put by US government, the cost to the end customer will go up, and it has gone up. So in the short term, there will be softness in demand, and that is why our third quarter is likely to be softer. Now the supply chain is going to be intact, but at least the cost increases to the end customer, means our customer's customer. It takes time for it to stabilize here. So hence, in the short term, we are seeing softness in performance.
Okay. Just one small thing. I was reading Caterpillar's Concall. So this quarter they have done good volume, and the commentary is also positive for Q4. So they are saying that the end demand is still strong. So I am thinking, what is the mismatch here? Because
see, Caterpillar is
quite bullish.
Yeah, Caterpillar is a $60 billion company. They have more than 15, 20 different verticals. They have done exceptionally well this quarter because of strong output from their energy sector. While we supply to the mining and earth moving and the ground engaging tool sector. So overall, Caterpillar may be upbeat on the future guidance, but we have to also see, how the different other sectors move. So what we've been guided by our customers is Q3 will be a little softer, and Q4 onwards will be back on track.
Okay. Okay, understood.
Thank you, Harshil. Thank you.
A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Sahil Sangbi from Monarch Networth Capital. Please go ahead.
Yeah, good evening. Thank you for the opportunity and congratulations on very good margins. My question is pertaining to GET. So if you can give us some more details on what were these development orders, up to what quantum, and how do you see this scaling up? What kind of timeline do you see on this product line?
End user sales Vodafone. Any other questions, Sanjay bhai?
That's it, sir. That's
Yeah. The ground engaging tools segment is one of our future forays. We want to really develop this. At this point of time, our sales to GET segment is very minuscule. Over next 2-3 years, we want to do at least 5% of our revenue into ground engaging tools. We are quite bullish on this. We have more than 12 components under development in ground engaging tools, and hopefully from Q3 and Q4 onwards, we should see a steady increase in sales in ground engaging tools.
okay. So where are we selling these products right now, and how many variants are these? And if you can just give some kind of numbers to this, and
These are sold from our customers. The countries which we are exporting now are US, Singapore, and some places in Europe. I think somebody is typing this. May I request to please stop this, please.
sure, sir. I get your answer. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Rahul, an individual investor. Please go ahead.
Hi, sir. Congratulations for a very good set of numbers. Sir, my question was that in the current situation of higher tariffs, are the customers like your esteemed customers from Long, are they requesting you to take some tariff hit into your P&L, or for the orders in the Q3? Are they telling you to take some tariff hit, or are they bearing all the tariffs?
Now, you have any other question?
No, sir. Only this one, sir.
Okay. Since this tariff issue started on April 1st, initially we got requests from I think 3 customers of whether we can share this extra cost to them. So we explained to everyone that this is a B2B business model, and when prices are settled, there is a very stringent and tight negotiations, and there is practically no room for any price reductions. So we have not passed on a single percentage price reduction to any of our customers, and customers are trying to mitigate this extra cost in their own way. And I think since June we have not been requested by any customers for price reduction, and our customers understand this, that it's very difficult for suppliers to mitigate this heavy cost increase.
Okay, sir. Got your answer. Thank you very much, sir.
Thank you.
Thank you. The next question is from the line of Shubham Thorat from Perpetual Capital Advisor. Please go ahead.
Hello.
Yes, please.
Hello.
Yes, please.
Can you hear me, sir?
Convert કરવાનું છે into our result. એ તો કરી નાખજો અઠવાડિયામાં. Hello?
Hello, sir. Can you hear me?
Yes, please go ahead.
Okay. So, sir, I'm a bit new to the company, so I just wanted to know what products do we supply to USA and other export markets except USA. That was one. The second thing is what kind of growth are you seeing in the mining and earthmoving division of yours? Third, you in last quarter, you had mentioned that few of the approvals from the railroad division are pending. So what is the status on that? And fourth and the final question is, what is our current capacity utilization and what is our guidance regarding that? How do we expect to ramp up?
Yeah. Rushil, are you there? Rushil? Hello, Rushil?
Yeah, hi. I can hear you.
Yeah, Rushil, can you just give guidance on the capacity utilization part, which Mr. Shivam is asking, then I'll answer the other two questions.
Sure. So, based on the conversion that we are seeing of our samples being developed, currently we are at about 48%. Next financial year, we see ourselves at about 68%. I'm sorry, 58%. And the following year, we expect to be above 75%.
Yeah, thank you. Now, we now export to about 15 countries and likely to go to 18 countries in another 1 or 2 quarters. Regarding these railways, there is not much movement in our development stage, and we are focusing on many other opportunities which we believe are more lucrative. And as and when we have operations in railways, we'll surely cater to that requirement. But the exports apart from US are to additionally 15-16 countries.
Okay. And any comments on mining and earthmoving division of yours?
Mining, earthmoving, we have already said in my speech that we have seen more than 10% growth in the current year, and we expect overall growth from this year to next year to about 20%.
Okay. And sir, can you please mention few of the products that you supply in the export market?
Yeah, these are steel castings, and these steel castings are used in different equipments like mining equipment, earthmoving equipment, construction equipment, railroad equipment, steel plant equipment, and other end user industries. So these are components which go into a machine, and we cater to 9 different industries from mining, earthmoving, locomotive, transport, construction, railroad, ground engaging tools, cement, steel, and defense. So these are steel castings going into this different equipments in different industrial segments.
Okay. And sir,
Thank you.
so these products are directly supplied to end user industries or are they sold through any channel partners?
No, these are all goes to the end customers who are all OEMs, and these OEMs are anywhere from $5 billion to $70-80 billion companies. We give directly to our customers who are all original equipment manufacturers.
Can you name some of them, sir?
Due to confidential reasons, we don't give out names of our end customers. We are only talking about the industrial segments.
Okay. Got it. Okay, sir. That's it from my end. Thank you.
Thank you. Thank you, Shivam bhai.
Thank you. The next question is from the line of K. Manjunath from Canara Bank. Please go ahead.
Chetan bhai, congratulations on the wonderful set of numbers in this challenging situation. I just have 3 questions, sir. Number
Yes, sir.
one,
Thank you.
in the last conference, you have indicated that you have developed some components for the export defense market. What is the present situation? Number two, what about your focusing generally in the OEMs? So you had also plans to enter the replacement market in exports. And my last question would be, how many years will it take to cross that 1,000 crore turnover, considering the present and future estimates?
Thank you, Mr. Manjunath.
Sure.
I think during beginning of the call, I did answer this, that for defense exports, we got the first trial order and we shipped about 250 different quantities in June, which were approved by the end customer. Then we got a development order of 2,000 numbers, which we have shipped in September. They will reach the end customer by mid-November, and hopefully we should see some additional volumes coming maybe from Q4 or maybe Q1 of next year. Regarding sales to OEMs, as of now, all 100% of our sales are to OEMs only. We are not going into replacement market, and even for the future, we will work through OEMs only and not directly in the replacement market. And your question about 1,000 crore when we'll reach, I'm also equally interested as you are. But everything, if things go well as planned, maybe FY29 we might cross 1,000 crores.
So what's our orders on hand as in date, sir?
All orders on hand in terms of value terms is about 108 crores.
Yes, sir. Thanks a lot, sir. Once again, congratulations on the wonderful performance.
Thank you, sir. Thank you.
Thank you. The next question is from the line of Shehzad Shroff from Demeter Advisors. Please go ahead.
Thank you for the opportunity. I had only one question on the EBITDA margins. We've done 27% in H1, and given we are saying H2 will be slightly softer, so can you guide to anything on the margin front for H2?
See, if you see EBITDA margin for the current quarter is about 32%, and this is higher by 4 basis points compared to the corresponding quarter. In this quarter, beginning July, the input prices went down, so we saved on input cost around 2.86 crore. Then cost reduction measures, which we do on an ongoing basis, we saved about 53 lakhs. And then there was a gain of 1.98 crores due to foreign exchange. So all put together, we got a one-time EBITDA gain of 5 basis points and rupees 5.37 crores. I think I've been always saying from past 3-4 quarters that our sustainable margins will be 25-26%, and then we might end up saving another 1 or 2% from exchange rates, cost reductions, improvement in productivities, etc. So on a longer term, 25-26% looks on a sustainable basis, and then maybe we end up saving another 2-3% here or there. So we might do about 28-29%.
Understood, sir. That answer. Thank you.
Thank you. Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Srinath V from the Bellwether Capital. Please go ahead.
Hi, sir. Congratulations on the good set of numbers. Wanted to understand more from a 3-year window, what are the kind of interesting new opportunities or product developments at a sector level or directionally sub-sector level that you could share just for our understanding as to what are the opportunities you're pursuing, sir?
Yeah, thank you, Srinath, for joining the call and asking this question. I can say with all the disruption because of tariffs, but if you really see through the overall strategy of customers to find a replacement of China is still in vogue. We are seeing people coming to us to reduce the dependency on China. So on a macro level, the opportunities are tremendous. Second, all the OEMs who have facilities other than US are also contemplating sourcing products for some other countries other than US. So if they produce the equipment in some other countries, they will bypass the higher tariffs issue of US. So we are seeing our sales increasing elsewhere other than US in the current quarter. Third, Japanese markets are highly dependent on China, and we are seeing some good traction from Japanese market that they also want to reduce dependence on China. So if you consider the present geopolitical situation and the tariff issues, I think going forward in another 2-3 years, there may be tremendous opportunities other than US. Moreover, trade agreement with UK has been finalized, and our tariffs on steel castings are lower in UK. The tariff agreement with the bilateral trade agreement with EU is almost being finalized, and of course the US also. So net across the world, India will be far more competitive than what we were a couple of years back. And people do see with us with a lot of respect and want to consider India in general and maybe company like Steelcast as a replacement who were dependent on China.
Got it, sir. One more follow-up on this. Wanted to understand, some of the wins that we had in the last few years came from existing customer, but new parts and new facilities, different facilities that we are not addressing. So do we continue on that path? Are there more opportunities with the existing customers for newer, products in different facilities that we may not be working in?
I think a very good question. In past 3 months, we have received development orders for parts, which are from existing customers, but not for the US market. But these are for France market and Brazil. So those parts are under development now. So going forward, the customer is from US, but we'll be supplying to their facilities in France and Brazil. So there are a lot of opportunities, and that is one reason we have been saying that we have grown CAGR of 24% in last 4 years, and we will surely do 20% plus CAGR growth in the coming 3 years. This is because of the different opportunities, what we see on the horizon and what we have already in our hand.
Got it, sir. Got it. Thank you, sir. Thanks for the clarification, and congratulations on the good set of numbers, sir.
Yeah. Thank you, Mr. Shah. Thank you.
Thank you. As there are no further questions, I will now like to hand over the conference over to management for closing remarks.
Thank you to each one of you for being part of our earnings call and participating well. We appreciate your support and trust in us. We hope we've been able to address most of your queries. In case of any further queries, please do not hesitate to contact our investor relation advisor, Ernst & Young, and they will connect with you offline. Thank you again, and thank you to E&Y for supporting in our endeavor. Thank you.
On the behalf of Steelcast Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.